We just kind of hit the estimate, 100,000 jobs added. I think everybody knows there's some other factors in there. There's severe weather, hurricanes, and things like that. There was also the strike at the ports. I want to get a sense from you. When we're looking at this jobs report, do you think the Fed is factoring all those issues in, or is that big decline month over month, is that what they're really focused on?
The one thing the Fed focuses on is that they don't focus on the one data point per month. In fact, every month that the data comes out, the Fed looks at two data points. One is this payroll survey, which Wall Street seems to focus on, but the Fed also looks for verification. How many more people are being employed month to month? And if you look at that number, the household survey, which is what is used to construct the unemployment rate, you find that year to date, that has only increased by an average of about 31,000 per month, much less than what the payrolls are showing us, which tells me that a lot of people are working multiple jobs, that a lot of jobs being created, but the number of new people being employed are much less. And I think that's showing up in the polls because people are saying, hey, I can barely make ends meet. I have to really work like hell to pay all my bills. And that's showing you that a lot of the jobs being created are really being created in the lower wage sectors. So that to me is a vulnerability that the Fed is going to keep in mind.
So bottom line that for me, Bill, do you think that makes it more likely the Fed would cut or less likely the Fed would cut?
Actually, the vulnerability allows the Fed to proceed as normal because we've had a lot of surprisingly strong data coming in. GDP and personal income numbers have been way stronger than what people had been expecting at this time. Remember, it wasn't so long ago that people were worried about a recession. But the fact that the strong payroll numbers have some weaknesses underlying it allows the Fed to say, hey, look, combining the data all together, we can still proceed with 25 basis point cuts between now and the end of the year.
All right. So, Bill, I generally know you to be a pretty upbeat guy. You're coming with some downbeat data for us today. One thing that you're looking at is household disposable income growth. It's actually slowed quite a bit. When we're looking at that, why is that so concerning compared to other data points?
Well, it's because most of the growth that comes from GDP comes from consumption growth. And the basis for consumption growth is, as you know, income and wealth. And because, as I said, the income that's being generated by the new jobs tends to be smaller and smaller because the new jobs being created in the low-wage sectors, more and more of the consumption has to depend upon the wealthy people being able to dip into savings that have been really blown up by the stock market increases and the property market increases. So when you look at it, much of the growth, the consumption, 40% of the consumption is being accounted for by, say, 20% of the population, because stock market and pension funds are owned by the top 20% of the population. Over 70% of those assets are held by the top 20% of the population. So the base of consumption is getting narrower and narrower, and that disposable income growth is slowing down because the stimulus boost that we got last year, which allowed income to grow by well over 10%, is now coming back down to like 5%.
Okay. So just really quick, Bill, does that mean that you're growing less confident in the so-called soft landing, or you think we're heading towards a no landing? What does that mean when we're talking about the economy overall, the fact that the consumption is narrowing so much?
We still have income growing faster than consumption, so I think we still have the soft landing in mind, but the downside risks are getting bigger and bigger, and that's something that the Fed is going to use to temper whether or not they're going to use 50 or 100 basis or 25 basis point cuts. The 25 basis point cuts is still the norm, but they're going to keep the 50 basis points in their pocket in case the consumption starts to fall off the cliff.